Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq, with daily insight on the Nasdaq-100 index, or the NDX, which is made up of 100 of the largest domestic and international non-financial innovative companies listed on Nasdaq. The NDX has been the barometer for U.S. large cap growth and also one of the best performing indexes over the last decade and a half, not to mention one of the most liquid index ecosystems in the world. Joining us this Wednesday afternoon, we have Brian McCormack, factor and core equity strategist at Invesco, to discuss Nasdaq-100 weekly performance. Brian, it's great to see you. Happy New Year. Welcome back to Trade Talks.
Happy New Year, Jill. Great to be here.
All right, Nasdaq-100 off to a little bit of a slow start here to kick off 2022.
Yeah, and you know, just the final wrap up for 2021, it underperformed the S&P 500. We had QQQM up 27.33% for the year, QQQ up 27.25 against the S&P 500, which was up 28.68%. So, you know, needless to say, a pretty good year for both the S&P 500 and Nasdaq 100. And you know, I think thus far, as we look at 2022, kind of off to a similar start to what we saw last year, right? With QQQ and QQQM down 1.25%. This past week, S&P 500 up 17 basis points, and S&P 500 value up over 1.6%. So, you know, kind of the market is focused on the strength of the economy, very similar to what we saw last year, and value had a great week, while, you know, kind of the growth-oriented Nasdaq 100 strategies underperformed. Now, you know, although we're seeing COVID cases surging thanks to Omicron, you know, the street seems to think that the economy is well equipped to handle the uptick. And similar to the vote of confidence that we saw given by the Fed last month, when they announced that they're going to speed up the pace of their asset purchase taper, that was a sign that the economy is on firm enough footing to handle that change. Now, you know, we look at the discussion of a strong labor market, which has been kind of paramount to some of the Fed commentary. That was evidenced this morning by the ADP employment report that showed in December 800,000 jobs added. That's nearly double the economist's forecast of 410,000. Looking over the past week, we saw the yield on the 10-year Treasury jump to over 1.64%. Today, it's approaching 1.7%. Again, on the back of economic strength and 3 potential rate hikes from the Fed after the asset purchase program is set to conclude in March. And as inflation continues to persist, we'll see that next week with the release of December CPI. But about an hour ago, we saw the release of Fed minutes from the December 15th meeting. The main theme here was that we could see rate hikes sooner than expected or at a faster pace, given the inflation, employment picture, and economy in general. I think beyond that, the next discussion is going to be the reduction of the Fed's balance sheet, which some participants thought that could be appropriate after liftoff of the Fed funds rate. But you know, I think today a little bit more hawkish than the market may have been anticipating, with the discussion of a faster liftoff or faster pace of rate hikes. And sentiment today seems a little bit more cautious, with equity markets extending losses after the release of the minutes.
And Ryan, if we break it down a bit more and we take a look at sectors, what have been leading the way and what have been lagging a bit here?
Yeah, so I mean, you know, I think that the story is kind of value-oriented sectors, energy and financials, who, you know, kind of the stars of the first half of 2021. This past week, we had energy within the S&P 500 up over 5.5%. Again, on the back of stronger economic growth, maybe an increase in human mobility once we get past this kind of Omicron variant. Financials were up nearly 3.5% alongside interest rates, and QQQ's lack of exposure to both of those two sectors weighed on relative performance against SPY. You know, the more growth-oriented tech and communication services sectors traded lower, which hurt relative performance on Qs. Tech was dragged lower by Microsoft and Nvidia, and in communication services, Meta, Netflix, T-Mobile, and Alphabet weighed on that sector. So kind of the growth-oriented names under pressure with higher interest rates, those value-oriented kind of stars of the first half of 2021, energy and financials leading the way higher for the S&P.
All right, Ryan, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.